So today we want to talk about life insurance similarities, and I'm talking about cash value life insurance specifically. I'm going to compare it to real estate in terms of creating generational wealth. Which one performs better? I wrote a book called Creating Generational Wealth, What the Super Wealthy Know That You Need to Know. Make sure you get a copy of that book because I'm working on the second version of it. It's going to be fire. All right, so let's understand something. There's a house and then there's mortgage. They're not the same thing. A mortgage is a loan that you took out to buy the house. It's like taking out a car loan. It should have been called a house loan. In that way, people don't get their mind twisted when they're looking at their real estate. But it's all the mind game. Because when you think about a car loan, you never ever say, you know what, this is an asset, right? You say it's a car loan. I just purchased the car to drive me to work. You use the car as long as it can move. You drive it to work. Same thing with a house. So as long as you understand that a house is a place that you reside in, it's not an investment. It's only an investment once you have renters in there paying rent to you. And it's only even an investment if you're making money off of that rental income. So first off, let's take an example of a real estate project, right? Let's say you want to buy a house and the house is $500,000. Let's get a calculator. We're going to get a financial calculator, like a loan calculator. And I'm going to do the math, okay? 500,000, 30-year mortgage, 5% interest rate. The payment is going to be $2,600 a month. That's $2,684.11 to be exact. And then the monthly interest that comes off of that $2,684 is $1,295. That's how much goes to the bank. That's the interest that goes to the bank for the benefit of them loaning you money. I'm not upset with the bank charging interest because they gave you $500,000 to go buy the house, right? That you want. But don't say that that's generational wealth, because if you drop dead immediately, how will your family pay for the house? They cannot. They might not be able to afford it, and there's no equity in it because it's a brand new purchase. You have no equity, so how is that generational wealth, my friend? Are your kids able to continue paying it? Can they even pay the property tax on it? So it's not generational wealth, because it also goes to probate court before your kids can get it, and then your kids have to even go get permission from a judge to be able to do what? Talk to the bank. That's a lot of stress on children that are mourning their parents. Why do you want to put them through that? Now, of course, you could have a trust and all the other great things, of course, but the trust is a different conversation. It doesn't have nothing to do with generational wealth in terms of the real estate. The trust is just another entity that's holding the real estate, but that don't have anything to do with money. If the trust don't have no money, it can't do anything for you. It has to have money. The children will be able to access the money to pay for the mortgage. There's no money, they cannot pay for it, so the trust is useless. Make sense? I hope you get it. So let's deal with that. At the end of it, if we add up all the numbers, at the end, the total amount you're going to pay in interest to the bank is about $466,000. So the question really is, how much equity do you have in 30 years? Tell me, how many people do you know that have stayed in their house for 30 full years? They sell it in 5 years. They sell it in 8 years, 9 years, 10 years. Sold. I'm going to talk about the life insurance. I'm going to show the same example, use the same money to purchase life insurance. All right, folks. So I'm going to share my screen, and while I'm bringing that up, I'm bringing up my screen. It's going to come up in a minute. But in the meantime, what I want to do is go in and build a plan using casual life insurance. So I'm going to do two plans, actually. I'm going to do one with a whole life insurance. Why? Because whole life is more guaranteed. So I'm going to use that. And then I'm going to build one with an index universal life as well. Now, I have a number of companies that I use that I actually like what they have going on. We're very strong. So if you are in the industry and you want to tap into one of these carriers that we use, listen, hit us up, become a part of our organization. We have some proprietary tools that we use that a lot of other organizations don't have. And we take care of our sales force. So if you're an insurance agent out there and you're struggling, you're trying to figure it out, and you're not getting any trainings, hey, listen, contact us, DM me and say, hey, I want to be one of your agents. I want to be in the business. And then we'll take care of you and we'll be able to help you scale your business so you can start making six-figure income right away. So let's go. So I'm using a whole life for the first scenario. Again, I'm going to design it the same way that I built the mortgage. So I'm going to use a $500,000 mortgage. But because it's life insurance, you can't really design it like that. So here's what we're going to do. Because the mortgage payment was $2,684.11. That's how much his mortgage payment was going to be. But like my mentor told me years ago, he said, Douglas, you don't need to buy a house. It's not generational wealth. If you really want to build generational wealth and leave money for your family, then get life insurance. That's the true generational wealth, because you're using a penny to buy a dollar. Man, listen, that made so much sense to me. So what I did, he said, take the same 2,680 and put it in your life insurance policy. And I promise you, it's going to work out miracles for you. But check this out. Make sure they build it correctly, meaning you have a lot more money going towards the cash value and a little bit of money going to the debt benefit. Just like a mortgage, you know, the interest, the principal and interest goes to the bank, principal goes to help you reduce your loan balance. So let's do that. So in this case, with this company, for those of you online and watching this, you're going to be able to see me share my screen using a company called Mutual Trust Life. One of our carriers that we use, we're independent with them. Very big company, good company. We love them. They're part of the company called Pan American Life Insurance Company. We use them, but we won't block out some things too, just in case. But we use them. So this is what we do. So I'm just going to build it regular, with maximum accumulation solve. Just build it that way. Money EFT. So we're going to put in 2684.11 and we'll run illustration. That's it. Just run it and then let it come and let it do what it needs to do. And then boom, we'll come back. That's the illustration system. Okay. Now, this is life insurance at the finest. Okay, it's life insurance. So the way I built it, I've designed it just like a mortgage. What do you mean by that, Douglas? Well, let's talk about it. So 2684.11. When you take that, multiply it by 12 months, it's going to give you a number. So in this case, 2684.11 multiplied by 12, boom. That's $32,209. That's the amount. So for those of you on the screen, let's go in and bring up a calculator. I think that will make it even sweeter. We'll have a calculator on the screen, right? So you can see it. We will calculate it out. You can see exactly what we're doing. Because I like doing this. I like you to follow in the footsteps and learn, right? So let's go. So it's 26. What do you say? 26. Let's go back to the loan calculator. All right, the mortgage payment in the previous example was 2684.11, then multiplied by 12 months, boom, boom, $32,209.32. Okay, great. So now let's go back to our illustration. Go back here. So as you can see, what I've done is I said, okay, Mr. Computer, $11,863 is going to go to the insurance company. And look at the coverage, $696,000. That's how much life insurance he has. Folks, let me ask you a question. If this guy dies today, right? He has a real estate property and his children that he just bought yesterday, closed on it yesterday and drops dead tomorrow. How much would his family get? Yes, they get the property, but can they afford to stay in the property? See, that's the mistake so many people miss. They miss out on protecting their family in case of death. You put a roof over their head, but that roof is going to be off their head. You get me? It's going to be off their head when you die. No more roof. Done. I don't want that. In this case, with this insurance, guess how much they'll get? They'll get a check for $696,000 immediately. And all you paid was $2,684. Boom. You drop dead the next day, money in your children's pocket. $696,000. That's a lot of money. I get excited with that. Wish my parents did that for me. But they didn't have that in Africa. But anyway, let's go. So 11,000 goes to the bank to let me just keep it simple. Let's say 50% of that 11,000 goes to the insurance company. So mutual trust gets that money. The other 50% goes towards the cash value because it's going to earn interest. Now, then we have this 20,000. What is that? Well, this $20,000 is the extra money. You know, like in your mortgage, you make extra payment on your mortgage. So instead of making extra payment on a mortgage, why not pay it here? Put it in here. Just pay what the mortgage company tells you and put the rest in here. So now this is the extra payment. So because we're making extra payment, this is going to give us access to funds a lot faster than a mortgage. Check this out. So now think about a mortgage for a second, right? If you have equity in your house, how quickly can you get it? How quickly? I didn't say can you get it, I said how quickly? Well, you got to go to the bank first and ask them for permission and beg them to give it to you. They're going to run your credit, they're going to check your income to see if you can even pay the money back. This is your equity. And then when they finish all that, you're giving them all these documents, guess what the bank will say? Well, we can only loan you up to 70%. 70%. Man. And people are not getting upset about that. But let's keep going. Look at with the insurance, immediately there's equity of $18,000 in equity in the first year, which means you could borrow up to $18,000. Now you might say, well, you put in 32,000, you can only take out 18 grand. Yes. You put in 32,000 in your house. How much can you take out? See, would your house pay for your funeral? No, it's going to be foreclosed on. But yet the media has brainwashed so many people to think that it's a bad thing to put that kind of money in life insurance. Think about that for a second. You're paying a mortgage that only gives you could get a roof over your head by getting an apartment, renting. It's a house to live. It's not an investment. This right here is a true plan that will make sure your children are not out on the street, tax-free. So now, the second year, you put in 32,000, now it goes up 41. It keeps going up, the amount of money you could access with just the fax. You don't have to walk to the insurance company. You don't have to show a credit card, credit report. You don't have to show your social security number and your W-2 income, and you don't have to download bank statements. You don't have to go, you don't have to do any of that. You just fax a form and they send the money right into your bank account. Where can you get this type of deals? Where? Nowhere. Only Cashwell Life Insurance. This whole life policy is guaranteed to pay out the money, and it goes all the way, all the way. Now check this out. What about when this person, I did it on this example, was a 36-year-old guy that is looking to start his life. At 65, he's going to have $1.2 million, 30 years from today. 30 years, the property will be worth $2.6 million. When I say property, I mean you. That's your value. See, the thing is this guy just put a $600,000 value on his life. Just like you put in $500,000 of property insurance on your house to protect it from fire and all the other stuff. What about you? What about if you catch fire? If you get into an accident, who's going to pay anything? See, so as you continue to grow, your value grows too. Now in 30 years, $2.6 million. That property, would it be worth $2.6 million 30 years from today? Or from 30 years from when you bought it 30 years ago? We're going to look at that. We're going to check that out. You tell me, for those of you that have property, that bought property 30 years ago, can you put in the chat box how much that property is valued today? And are you still the person living in it? Did you buy it off of someone? My real estate folks, you know, you have this answer. Put it in here. Let's be real. Hey, listen, don't be upset at me. I'm just trying to help the consumers out. We're not saying don't buy a house. Houses are great, but call it what it is. Don't say it's generational wealth, because it's not. We all know it's not generational wealth. We're real with it. You call it the same. Say it's not generational wealth. Say the truth so that the American people are not deceived anymore. It's not generational wealth. True generational wealth is for life insurance because it's going to grow with you and your family will be done right. The second company I want to pull up, let me see if their stuff just takes, it's weird, this company. You know, we like them, they're good company, but man, they have so much stuff on their system that is just ridiculous sometimes. So let's try and keep it, let's try it again. Because I want to build this time on IUL. IUL is a little bit different from whole life. Here's the difference. IUL is based on speculation. Whole life is guaranteed compounding interest. IULs are not compounding interest in the traditional sense of compound interest because you can also have a 0 year. And if you have a 0 year, then nothing compounded except the old money, but it compounded on 0. I want my money to be compounded on a consistent basis. Now, I sell a lot of IUL. I love it. I own a whole lot of it. I own it, but I'm here to break it down for you. So whole life makes sense, but it only pays us very low interest, 4%. You know, IUL, on the other hand, gives you an opportunity to get a higher interest. But just know it's speculative. You will never lose no money. You always gain. So they're both great. I love both. And you could have both. Don't get caught up with, oh, I just want whole life. No, get both of them. They just have to be designed correctly. So let's build one. So what I've done is I've done the same thing, but I'm doing on IUL. But this time I'm actually using an older age person. The reason I'm using an older age person, he's 45 years old, because I want to show you that with life insurance, it doesn't matter. You know, the key is the amount that you're paying in, right? So what's going to be the difference will be the amount of coverage. So with an older person, it's going to be a less amount of coverage than a younger person. Right? But here we're not designing it based on the coverage, we're designing it based on the premium that he's going to be paying. All right, so coming back to that's the IUL. So let's go in and build it. Let's say let me share my screen, right? Because you need to see it. Okay. So what I've done is, as you can see, the screen is this. The coverage amount is $554,000. That's the coverage amount, $554,000. The premium is $26.84. But here's the difference, okay? So as you can see, in this case here, because this guy's 45 years old, his actual premium, if we're looking at this like a mortgage, this is his principal and interest payment. Principal and interest. So what goes to the interest? In this case here, $4,398 will go to the insurance company to cover the $555,000 of death benefit. Now, you might be, what's $4,000? That's $4,000 a year annual. So do the math divided by 12 will give you a number. The remaining balance, about $5,000, will go towards the cash value. But we're not just doing the $9,000 a year. We're actually doing $32,000 a year. So there's a whole lot more money going towards the cash value. And as you can see, we'll put in 32,000. Again, remember, this is all hypothetical because we don't know what the market is going to do. So it's not guaranteed. Like the whole life is more guaranteed. It pays a guaranteed interest rate plus dividends. All right. With life in whole IUL is not guaranteed. So your numbers could be higher. It could be less. I don't know. So we cannot guarantee that, but it's okay. They still perform. They still perform. They still won't do what needs to be done. So in this case here, the account value is $28,249. I call that your equity that you have in your cash value life insurance, just like equity in your house. Now, here's the deal. The insurance company, in this case, they're the bank. They're like, hey, we could loan you up to $15,000 of this equity. Now, that varies with company. Every company is different. It just depends on the scenario, the situation. All right, you might have to wait before you're able to access money, meaning it might be a year, it might be 13 months, it might be 15 months, but they will let you know where you can access funds from your IUL. Okay, so every company is different. And then there's other riders you could add to it to give you access quickly. But that's a little bit more training for the agent. But for now, just to keep it basic numbers, all right? So as you can see, the equity is growing and the access to fund is growing. And before you know it, you could take out 100% of the equity. See that? Boom, 100% of the equity in after 10 years. Now think about it for a second. With a house, can you ever take out 100% of your equity? Only when you sell it. But you don't want to sell it because if you sell it, you got to pay capital gain tax. So why do you want to sell? Same thing, folks. If you cancel your insurance policy and you made more money than you put in, you will be taxed on the gain. Okay, so do not cancel your policy. Cancel it when you die, because when you die, it will be canceled automatically, and your family will still get the death benefit tax-free minus any cash value that you might have taken out in form of a loan. So make sure you take your cash value out in form of a loan. Do not do withdrawals. Do not withdraw the money. Take it out in form of a loan. I've done numerous of training on loans versus withdrawals. So make sure you check that out on my YouTube page. Make sure you subscribe, like, and follow. Okay. So as you can see, it continues to build. Now let's go, because remember, this one is a younger kind of guy. He's young. He's not 36 years old like our first guy. So he turned 65 pretty fast. But look at how much he has. He still has $1 million saved. And that's at age 65, which is 21 years from the day he started. So in his policy, he has $1 million. His policy is now worth 1.7 million. That's his value. If he drops dead, his family will get a 1.7 million tax-free check. See that? And then the key is using all this cash along the years to buy properties. You see how I flipped it back? See, we're not against real estate. We just show you a different way of buying it, where you still win, just in case death happens. See, the key is winning, winning, winning. So let's keep going and looking. In 30 years, when he's about 74 years old, he'll have $2.3 million in the account. Let's highlight that real quick, make sure, because see, $2.3 million. That's how much he's going to have in his account if something happens. Make sense? Good, good, good. And then his death benefit, 2.9 million. See, I wanted to show this because so many people want to invest in real estate, so many. And this allows me to help you break it down correctly so you understand the value of casual life insurance. I know you've been brainwashed by the banks, the media, the government. Unfortunately, we as consumers get our license and we repeat the same thing that we've heard from the media, the government, and the banks. So don't blame your real estate agent. They just don't know. They're a consumer just like you. They used to work a full-time job somewhere and they went ahead and get their license. Now they become a real estate agent. Now they start giving you advice based on the knowledge that they have. Folks understand this. Same thing with me. I'm a financial advisor. I used to wait table at IHOP. And then I went and got my license. Now I'm advising people on how to handle their money. But what made me different is this. What made me unique is this. I decided to step outside the box. Instead of listening to what the media, the government, the banks are saying, I said, you know what, let me study the wealthy families. Because if you want to learn something, learn from the people that have already achieved it, not the people that are just talking about with sound bites. So I went and I started researching all these wealthy families. And I said, follow the money. If you follow the money will lead you to where you're going. So I started following the money and I started seeing that banks love life insurance. Banks will loan you money to buy life insurance before they loan you money to buy real estate. Think about that for a second. What do you mean by that, Douglas? Listen, we have banks that will loan you money. It's called premium finance. So if you have a certain net worth, see, a lot of you are no longer civilians. You make a lot of money, but you're still dealing with the guy that doesn't even know about how much wealth you have because they don't have that kind of wealth. So they can't advise you properly. So if you're a high net worth individual and you're looking to really get into a situation where we could have a bank pay for your life insurance, hey, make sure you send me a DM. I'd love to help you structure a very, very rewarding policy for your family. Because we're not just talking about debt, we're also talking about estate taxes, right? You got to protect all that. See, the system allows you to be able to properly plan for the future, protect your hard-earned money. We're not saying don't pay taxes on the money. We're just saying pay your fair share. That's all it is. You don't need to give the government a tip by giving them a tip while you're alive, giving them a tip at death. Come on. Why? So, folks, thank you so much. I hope you enjoyed this video. I appreciate you tuning in, taking the time watching the part 2 and enjoying it. I hope you enjoyed it. If you do, please put a comment in there for me. It makes my heart feel good. I appreciate every one of you that keep hitting me up. Hey, listen, increase my following on my subscribe on my page. Why not? Share the videos and let other folks enjoy with you. See you at the top. Thank you. Bye-bye.